coolest intros ever, man. I love that thing. Gets me fired up every day. I'm Dustin Tibbetts, financial advisor with Jazz Wealth. Welcome to the Dough Show, everybody. Today is Friday, and we've got a special video to help you get your dough straight today. I think this is going to apply to a lot of people, although I'm only really talking to you-know-who. So here's the deal. A lot of people come to us and they open retirement accounts, right? And so, great. That's what we do. That's our business model. That's what we hope you'll check us out for and maybe consider us for if you need help. If you're just not getting where you want to be with your retirement accounts or not sure how it all works, well, that's what we're here for. We work with investors of all sizes, no limitations, no strings attached. You can see everything you like to see on jazzwealth.com. And of course, if you have any questions, let us know. Here's the thing. In retirement accounts, the tax benefit and tax consequences are known up front. Meaning in a Roth IRA, you can open an account and you can start buying and selling as much as you'd like with really no tax consequence. So if you buy something on one day and 5 days later you decide to sell it, the IRS doesn't care. They've agreed that you will no longer pay tax on any money that, whether it grows or whether you put money in there, whatever it happens to be, they agree that you won't pay tax on it. In an IRA, of course, you put the money in and you're saying, I'll pay the tax later. Let it grow and grow and grow and grow. And as I start taking money out little by little in retirement, I will give the government their fair share, right? So no big deal. Here's what's happened though. Back in the day, in my day, it used to be that if you wanted to trade, if you just wanted to buy and sell with no retirement vision, you could just open an account at TD Ameritrade. Or TradeStation was a popular one. Lightspeed was a popular one for day traders. I go back to the days of Zecco, right, where they used to be big. So here's the Scottrade even. What you could do with those accounts is those companies would say, hey, put whatever you want in. You put $5,000 in and you want to buy and sell stocks each and every day or every couple days or whatever. They didn't care. They charge you a small commission for doing so and you could just trade away. Well, nowadays, people like to use Robinhood. Robinhood's quite popular, actually, and so I'll give you a little industry background here. 2 months ago, Robinhood opened 1 million accounts in 1 month. Now, when you dig a little bit deeper, most of those accounts had a couple $100s in them. So they weren't large accounts. Now, that's not bad. I won't say anything bad about Robinhood. Great service if you want to go ahead and try to use it. But the problem is people will forego almost everything as far as advantages go if you tell them it's free. And so a lot of people go there because they say it's free. Now you can pay them for different things, but it's free, so people will go and open accounts. Now a lot of people go, oh man, they opened 1 million accounts, but nobody put in any real money. And that's okay. Their vision is for the smaller person as well, I believe. Well, they didn't have as much money as they hoped would come in, so they had to raise money. And they raised a ton of money, by the way, which, if anybody happens to know how they raise their money, let me know. I would love to raise money for this company. If you happen to know a VC firm or any sort of angel investors, I'm in. I'm willing to work with them. Nobody wants to talk with me. But these guys had to raise a lot of money. What I read into that was not that the business maybe is struggling for money or that they're growing at a pace they can't keep up with. Who cares? They'll deal with it. They're smart people there. What I read into it was, oh my God, these people that just opened their accounts all opened taxable accounts and maybe shocked at the end of the year when they know like what they might have to pay. Now on the other side of that, people at Jazz Wealth will open retirement accounts and they go, Dustin, hey, it's halfway through the year. I put in the max amount. I can't invest anymore in my Roth IRA, but I do want to invest. What do I do? And so I always tell them, well, it may be best that we open an individual account, maybe a joint account with your wife or your spouse, or what we call a taxable account. They're all the same thing. Now, this account has different rules. Now, in an individual account like at Robinhood, or if you open one here, you can do whatever you like. You can buy and sell as much as you like. Nobody cares. You can put as much money in as you like. You could take as much money out as you like. Nobody cares. But the IRS says, hey, wait a minute. We just want our money. If you make some money, we want our money. And they break the rules down, sort of complex, but we're going to go over them today. So there's a few things I want you to consider. No matter where you go, no matter what you do, if you have an account at TD Ameritrade, if you're day trading, buying and selling, if you are at Robinhood, wherever you might be, or you're here at Jazz Wealth and you're considering adding an individual account, we do need to talk about some things. I'm always going to stop customers from doing something that costs them more in the long run. It'd be easy for me to say, sure, open a taxable account, put $50 million in there, and we'll just go ahead and we'll manage it for you. And then you find out you've got this tax bill, you'd be pissed, right? So I'm always going to try to stop people from paying any more than they absolutely have to pay the IRS. Here we go. So we're going to start with long-term capital gains. In a taxable account, here's how it works. Let's say you bought something and a couple days later you sold it. Well, if you made a profit on that, you are falling either into short-term or long-term capital gains. Here's the deal. We touched on this a little bit yesterday. Long-term capital gains are if you hold the position for 1 year and 1 day. So if you bought a stock and you, let's say you bought it today, and 1 year and 1 day from now, you sold it for a gain of hopefully a lot, right? $1,000, $5,000, whatever it may be. The IRS says, okay, you fall into this bucket. We want our long-term capital gains from you. Well, what is long-term capital gains? We'll go over that in a second, but it is either 0% tax or 15% tax. Oops. You get what I'm trying to write there. So that would be what you would owe. Either 0, nothing, hopefully nothing, or 15%. We'll talk about how you calculate that in just a second. Now, if you bought a stock today, over the weekend, you're at a barbecue, the guy that's cooking up in a barbecue goes, hey, turns out there's a better stock for you to buy. You get all excited. You want to buy that stock instead. You come in on Monday, you sell the stock, and go buy that hot tip that the guy gave you. Well, that counts as short-term capital gains, which really is just ordinary income, right? And that's just a fancy way of saying you're going to add whatever the profit was to your tax bill. So whatever your taxable, your tax bracket is what you're going to owe. So actually, let me erase the wash sale thing here for just a second, and let's talk about this. So long-term capital gains, here's how this works. I'm going to only do married filing joint today, right? Married filing joint. Most of you, married filing joint. If you're single, you just look it up. It's not so bad. Now, if it's a long-term capital gain, your two choices for most of you are 0 and 15%. It is 0% if your taxable income, I should say, if your married taxable income is $77,200 or less. Think about it. You and your spouse make money. Hopefully you make a lot more than that. But if you guys together are getting started and together you make $77,200 or less, then your long-term capital gains is 0. You don't owe anything. The government says, fine, you keep it. It's all up to you, all right? You would owe 15% basically for everything over that. I wrote the number down somewhere. $479,000. So for most of us, we're not going to go over that. As long as you stay under 479, then you owe 15% in long-term capital gains. Now, in the past, prior to this year, you'd go, okay, great, I'll hold that stock for the year and 1 day. I'm a long-term investor, that's fine. Because if you sold it prior to that, your tax may have been higher, and it was higher, right? Because of the tax rates. A little different story this year because tax rates are lower. So let's talk about this for a second. What I'm going to do is now change this to short-term capital gains. Let's say you bought a stock, you sold it 3 months later, okay? Now we're counting this as ordinary income. Again, we're going to assume you're married filing joint. The only thing that changes, where's the eraser? Oh, the only thing that changes is the number right here, right? 400. So let's get rid of this, right? Okay, if you're married filing joint and your income is less than $77,400, you're going to pay 12%. You're in the 12% tax bracket, right? It might make sense for you to actually sell sooner than you'd hope for if you fall into the 15% category, right? So it's 3%, big deal, right? But it's a little different now because the tax rates are lower. So in short-term capital gains, if your income is $77,400 or less, you're going to pay 12% on that gain. And then you know what it does. It goes to 22, 24, and 32, and you get it. right? So if in a taxable account you buy a stock, you sell it a day later, it counts as ordinary income. Whatever the gains were, not the value of what you purchased, but whatever the gains were. So keep that in mind. So if you made $1,000, you're going to add it to your income, and if you're in this tax bracket, it's 12% is what you're going to pay. If you made $1,000 and you're in this tax bracket, it's 22% for buying and selling. Just counts as income. You guys with me? You get it? Everybody cool? All right. So that's that. Now you know that in a taxable account, whether it's at Robinhood, whether it's with us, wherever you're at, if you're day trading, you really want to keep that in mind, that short-term capital gains, especially if you're making a lot day trading. If you're making a lot by investing at Robinhood or wherever you're at, you want to keep that in mind, right? Now, some of you might look at this and go, I've got an idea, right? Let's play some games with the IRS. What if I have, I don't know, 10 positions. All these positions. And some of them are quite profitable, some are negative, right? Some are really negative, and some are really profitable, okay? And you go, well, look, according to the IRS, as of now still, you can write off $3,000 worth of losses a year. Okay, so let's think about this. If you have a position, let's say this one here is down $3,000, right? And you go, well, we're going to get to the end of the year. What if I sell that position? I'll keep everything else. But what if I sell that position to lock in $3,000 worth of losses, and then the very next day I'll just buy it back, right? Well, that's kind of clever, because if you sold this for a $3,000 loss, you would have $3,000 in capital losses that you could put on your tax return. And then when at the very next day or whatever you might say, let me buy the stock back. I'll get right back into the position, but the books will show a $3,000 loss, okay? There's something called the wash sale rule. The IRS is so ahead of you guys on this one. They're not messing around. So here's how this works. The wash sale rule says if you were to play that game, right? Let's just do an example. If you bought 100 shares of, I'm not going to pick a stock. I'll go XYZ. Okay? So let's say you bought that 100 shares of XYZ for $100 a share. Okay? You have spent $10,000 to buy that stock. It doesn't matter. Whenever you bought it, you bought it right now. Let's say today you bought it, $10,000. Come the end of the year, the value of it is worth $7,000. So you're like, holy cow, I got a loss on this one. I'm losing $3,000. But it's okay because I can write off the $3,000 in taxes. That's great. That's like, that'll help you with the rest of your income. So you go, all right, let me do that. But I'll tell you what, just so I can lock it in, I'm going to buy it back the next day. I do like the stock. I do want to keep it. Everything is cool. So let's say you buy it back shortly thereafter, okay? That triggers what's called a wash sale. So you bought 100 shares at $100. You sold them for $7,000. You took the loss, right? Then you turned right back around and you bought the shares, bought 100 shares at now we'll be trading at, say, 70, right? And so now you're putting the 7,000 back to work, right? That's a wash sale. You're not allowed to do that. So you can't do it. Now, here's the key, though. So what you can do, and hopefully I don't confuse anybody. Let me know. I got the little chat thing open if I confuse you. What you can do is count that $3,000 loss towards your cost basis, okay? So we're going to get a little geeky here for a second. This is the process. You bought in for $10,000, you lost $3,000, right? So you took that loss, then you turned around and you bought it back. You didn't know the wash sale rule existed. You thought you were being slick and getting one over on the IRS. So you bought the shares back at $70. So you've got $7,000 back into this, right? Since you still have the $3,000 loss, no, you can't take it off on your taxes. It's not going to be allowed. It's called a wash sale rule. But what you can do is say, I've got a $3,000 loss, and your new cost basis for this stock is actually going to be $100, right? Or $10,000. You with me? So don't run. So now your cost basis is 100. You paid 70 for it. The IRS is not going to let you take that loss on your taxes, but they are going to let you carry it forward. Oh, that's a bad word. I didn't say that. They are going to let you add it to your cost basis. So what that means is although you bought back for 70, you don't pay any tax on this trade unless you make over 100. Okay? So let's draw it out like this. You bought at $100, right? So let's say stock price is trading at $100. You bought it today. 5 days from now, unfortunately, it's trading at 70. Okay? And you say, that's cool. I'm going to take the loss. Okay? You can't write it off on your taxes if you then turn around and buy it back at 70. So wash sale because you bought the same stock. And the way they actually say it is a wash sale is if you buy a substantially identical position. So it doesn't have to necessarily mean that you bought the same exact stock, right? It could be that you bought preferred shares. It could be that you bought an option on the stock instead. All that counts. It'd still be a wash sale. You buy back at 70, okay? So now you're back in, you get no tax loss. However, this from here to here, there is no tax. Although you'd have a gain to start offsetting some of your loss, you wouldn't owe any tax until you crossed the $100 mark. You with me? Okay, so in short, what this means is in an individual account, buy and sell all you want, but realize all those gains versus losses start offsetting against each other, and if they happen to be on substantially identical products, they get discounted 100%. You can't even use it on your tax return. So for example, if you had for the end of the year, you had say a $100 gain, a $100 gain, a $50 gain, and then you had $25 loss, a $100 loss, and a $25 loss, right? These all go against each other, right? So you've got $250 worth of gains. This $150 worth of losses comes off of this. So your actual net gain at the end of the year is only $100, right? Unless one of these is a wash sale, okay? So let's say you had a $100 gain on this stock right here, right? You sold it, and you turned around and you bought it and started losing $100. Done, okay? If you had a $25 loss over here and you sold it, bought it back, had a $50 gain, you don't get to count that $25 loss, right? You got to count this as 25, okay? So there's a lot of things you want to keep in mind when you do this sort of individual tax game here. Now, what we do is we built an algorithm that sort of works in the background. And what it does is it says, all right, Dustin, you've got a customer here that's got an individual account, and they've got all these positions, right? Let's say it's from here to here. And these are the losses, and this is the gains, okay? And so they've got all these positions in gains, and they've got some of these positions in losses. And this is what it looks like for us on our end. And so it says, Dustin, this may be stock XYZ. This may be a portion of stock Y, or you get what I'm doing here, right? And then the gains, Dustin, this may be stock XYZ. It could be something else, right? Something else. And so what it does is it starts to tell us, Dustin, this is what's happening. The client wants to take out so much money, but they don't want to pay any tax on it. How can we best do it? And so the algorithm tells us, we've got it set up where it says, sell off this position totally, sell off half of this position, right? Sell off all of this position, and sell off 1/4, or let's say half of that position. And the net taxable event is $0. So if you've got a taxable account, you've had it with us for a year, and you've got $10,000 in it, and you go, Dustin, something happened, got to take out $1,000. No problem. There's no tax penalty because it's not an IRA. There's no taxes due if we do our job. And what we do is we go in and we say, okay, the client wants $1,000. They've got $10,000 in this account. How can we close some of these positions to avoid any wash sale in the future, but also to make sure that they get that $1,000 tax-free? So that's sort of a geeky way to explain it. Now, the wash sale rule is 30 days before and 30 days after the trade, okay? So you can't go buy a stock and then see it lose money, sell it, turn around and buy the stock, okay? You got to wait until that expands. Now, how can you sort of trick the system? If you're still following me and this hasn't scared you away, How can you trick the system? Well, the rule is it has to be substantially identical, right? It's a wash sale rule if it's substantially identical. So I'm going to use an example of Amazon today. This is a popular one. Everybody wants to buy Amazon. You know, I get it. It's all exciting and everything. So if for some reason you sold Amazon and you had a $3,000 loss, you can't buy it back for 30 plus days without triggering a wash sale rule. But what you could do is you could go to XLY. This is actually an ETF. XLY is about 25% made up of Amazon. So you could theoretically, it's not perfect, but you could theoretically sell your Amazon for a $3,000 loss and go, Dustin, I just wanted to lock in the loss. I still want to participate in Amazon. I like tech. You could find an exchange traded fund that was heavily weighted towards your Amazon, and technically you could go buy that, hold it for 30 days, then close that position and jump back into your Amazon. You would technically still be participating in Amazon, but the IRS wouldn't know, right? So you could sort of sneak around that. An old game we used to play with the short-term traders that we used to do. Now, since that's 25% Amazon, you may want to do some math there and make sure that you're participating in Amazon the way that you like to. That's not really what this class is about, but you could play that game though. Okay, so the important thing to know is if you do trigger a wash sale, what happens is when you get your reporting at the end of the year to show all the trades that you did, it'll just say wash sale next to anything that doesn't count. And it's up to you to verify that and make sure those are all accurate. Then what happens, if you can't write off that $3,000, you do get to apply it towards your next purchase. So it's sort of a gift in a way if you want to think of it that way. Okay, so in short, I want you to know taxable accounts, no rules. Do whatever you want. There's no specific rule about what you can do with a taxable account as far as putting money in, taking money out, how much you can put in, how much you can take out, when you can put it in, when you can take it out. The problem comes when you start buying and selling stocks. When those transactions happen, that's where the problem starts to come in. If it's over a year and a day, then you either pay 0%, now you know what the number is, or you pay 15% and you know what the number is. You actually could pay as high as 22% if you made over the 479, but I rarely encounter that. Okay, then the other thing is short-term capital gains. If you hold it for less than a year and a day, and the short-term capital gains count as ordinary income. Now, if you're really picky about how much you pay in taxes, this may be the year where you could do something different there and possibly pay 12% on your ordinary income tax, short-term capital gains tax, depending on how much you made, okay? I'm not a tax guy, so please don't ask me the tax questions, just giving you what I know from the numbers there. Okay, and then the wash sale rule just means there's no game that you can play to trick the IRS. So in short, if you don't know what the wash sale rule was, I just scared the hell out of you with that, know that they're onto your games, right? They're not falling for it. You can't trick the system is basically what we want to say. Okay, that's all I had for you today as far as that goes. Now, many people do open these accounts because they've filled up their IRAs, and that's understandable, but I want to explain how it all works because I want you to be happy at the end of the year if you're working with us. I don't want you to be shocked, and if you're watching and you're one of our subscribers, I don't want you to be shocked if you're buying and selling left and right on your Robinhood account or you're a day trader. You're gonna spend probably the Christmas break to New Year's break trying to make sure you're doing the right thing there. Every year, that's what I would do, just to make sure it was done right. Michelle's back. How you doing, Michelle? You want to have me do a video on comparing renting versus buying, which is better based on income, rent, inflation. Is it better to rent versus buy a house? Okay, well, that's an idea. That has to do with your dough. I have a lot I could offer there. I like it. Henry's got to go back to work. Can you take a $3,000 capital loss against ordinary income, or does it have to offset against capital gain? I think you probably asked that before I got to it, but your capital gains and capital losses offset each other provided that they're not wash sales. What if you sell SPY and buy VOO? Does it count as too similar? As of now, it does not count as too similar, believe it or not. Dustin, can you touch on first in, first out of different purchases of the same stock? So what he's talking about there is if you buy Amazon at one price then you buy it at another price 5 days later, then you buy it at another price 5 days later, and another price 5 days later. How does the system factor in when you go to sell shares, how does it know which one you're selling, right? If you bought at different prices, how does it know which one you're selling? Thank the good Lord, or whatever sort of religion you subscribe to, that is mostly automated these days, so you don't have to deal with it. It is first in, first out, and thankfully the systems do it for you. Could you go through and do it automatically yourself? And at the end of the year, by the way, Punk, can you go back at the end of the year and readjust, right? You have the opportunity to do that. You can go to your brokerage firm and say, I see what you guys did there. I need to make an adjustment. They will do that for you, by the way. So if you're willing to take that extra step, you can do it. So you're playing the different brokerage account game. Unfortunately, the tax forms all go into one tax return, so the IRS still finds out. Do CDs and high yield savings accounts also count? Well, you're not doing any trading in those accounts. Today we're talking about buying and selling stocks inside of an account. CDs are their own product, and high yield savings accounts are their own that pay out dividends, and yes, those dividends are reportable. Are you going to be taxed on those dividends? It depends on how much you collected from the high interest savings accounts. So sort of general, but hope that helps you. All right, guys, hey, enjoy it. If I helped you in any way, hit the subscribe button, turn the bell on so you know when we come back later today. If I confused you, I understand. I get it. Yeah, I probably should have saved this for a Monday when we were all fresh and ready to go, but I did it today. All right, have a great weekend, guys. We'll see you later for the closing beat. What an interesting market day. What an interesting couple days in the market, by the way, if you've been following along. We will cover all of that today at 5 p.m. for the closing beat. Adios.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.